Welcome back, friends. Today we're going to work through depreciating fixed assets. We're going to start by calculating depreciation using various methods, including the straight line method, the activity method, the sum of years digits, and the double declining balance method. We're then going to expand on that and show how do we adjust depreciation if we change our estimated useful life of the asset. So how do we extend that is the example we'll be working through. We're then going to work through an example of recording impairment. So if our asset is deemed to be impaired after a triggering event, how do we record the impairment? And then how do we record depreciation going forward after the impairment of the asset? So with that said, let's get started.
A company purchased a new machine for its assembly process on June 1st, 2020. The cost of this machine was $175,000. The company estimated the machine would have a salvage value of $20,000 at the end of its service life. Its life is estimated at 7 years, and its working hours are estimated at 30,000 hours. The year end for this company is December 31st. So they're putting it into service on June 1st. The first year will go from June 1st through December 31st, which will be 7 months. So the first year will have seven months of usage, so 7/12 of usage in the first year, because it's basically June, July, August, September, October, November, and December. So, and then it has 7 full additional years. So step 1, calculating our depreciable base. So we'll take our purchase price, which was $175,000, and then we need to subtract out the salvage value, which will be $20,000. So our depreciable base is the purchase price minus the salvage value of or $155,000. That is our depreciable base. That is the amount we will depreciate the asset down by, so that at the end of its life, it will have $30,000 of value, or the net book value at the end of its life will be $20,000. Okay, so now we're going to do our depreciation schedule. These are under all of these different methods. What I have here is, here's our year. So this is our first year. I have filled in the usage, although we won't know this until it actually happens. I have just gone in and filled in usage for every year at this right now. You won't have this initially. It'd just be you'd have it for this year, and that's how you would record the activity, et cetera, et cetera, et cetera. But the portion of the year, we'll need this for, say, straight line, some of the years digits, and even double declining balance. The portion of the year, again, this is, if you see the formula up here, the portion of the year is 7/12 for the first year. That's how much of the first year the asset was in use, 7/12, because we have June through December. So 7/12, which is 0.58 of the year. And then in the last year, we're only going to have 5/12 of the year that gets used. So that is the proportion. Now we're going to calculate depreciation under these different methods. Under the straight line method, we have our depreciable base, which is $55,000 or $155,000. We need to multiply that times straight line, which would be 1/7 of the cost, because it is a 7-year useful life. And then for the first year, we're going to multiply that times how much of the first year we had. So depreciation for our first year under straight line would be $12,917. Now, I am going to extend this down. So to do that, for those of you not very familiar with Excel, if you put in $ ahead of your formula, if you look at my formula up there, I have $D, $8. That means that as I move this, as I copy this formula, it will always refer back to D8, which is my depreciable base. I don't want it to, otherwise your formula moves. It stays relative. The cells that's calculating are relative to the cell you're putting the formula in. I don't want that one to move. I do want this one to move, so I'm going to leave it there. So there we go. Now, if I just copy this down, it switches it. So if you notice, it keeps, I'm still referencing the depreciable base cell. My portion of the year is moving along with it. So that gives me my straight line for every year, which is basically 1/7 of the depreciable base. At the end of the period, I have depreciated $155,000, which is my full depreciable base, and I'm all good to go. So under my activity method, now I have made it such that my activity equals exactly the activity life of the asset. So that is how we're going to do this. So for the activity, what I'm going to do is I'm going to take my depreciable base divided by my divided by my total activity of 30,000 hours. That's going to be, that means I will have $5.17 for every hour that I use this asset. That's my depreciation rate. So I'm going to take that rate and multiply it times the number of hours this year that I have used. And that means my depreciation for that first year will be $14,466 and, well, 67 cents, but we're going to make that go away. Okay, now I just want to make that cell stay the same. And I also want this cell to stay the same. Okay. Now I will just copy that down. That gives me all the amounts, which is the 155 divided by 30 gives me my depreciation rate per hour, which is $5.17 every time. And then I'm multiplying that times the number of hours I've used, which in year 2 was 4,500 hours, which gives me a depreciation of $23,250. So that is under the activity method. Sum of the year's digits. So my sum of the year's digits, I have 7 years here. So if I did 3, 4, 5, 6, 7, I have 7 years right here. If I sum those up, I get 28. That's down here at the bottom, right underneath that cell. You'll see sum of 28. So if I sum up all of my year's digits, I get 28. We'll clear those out. So 28 is going to be my denominator. My first year is we use the number of years remaining at the beginning of the year. So in my first year, I'm going to have 7 years remaining out of 28. So that is my rate. I'm going to multiply that times the amount of my depreciation. Or sorry, multiply that times my depreciation base. Now, it was not a full year, so I need to multiply it all again by 0.58 of the year is what we're using of that first year. So at the time of acquisition, I had 7 years left, but then we've only taken whatever 0.58 of that because we did not use it for a full first year. So that's how we get it. We end up with $22,604 of depreciation under the sum of the year's digits method in the first year. Now, in our second year, this is a little bit different. So in our second year, the number of years remaining is going to basically be all of these. So that sum, if you look down there at the bottom again, the sum of that is 6.42 years remaining. Or if I just did this, let's say I wanted to do sum of all of these years divided by 28 was the sum of my year's digits. And as I copy my cell, I want the C20 to stay the same. So divide by 28 and multiply that times 155, which is my depreciable base. If I drag that down, this should work. The formula should work, and it does. So all I did was figure out what's the remaining number of years. That is my numerator. My denominator is 28, and then I multiply that times the depreciable base every year. So that is the calculation there. The remaining life at the beginning of the year divided by 28, which is the sum of my year's digits, multiplied by 155 gives me my depreciation amount. In total, I want $155,000 of depreciation. Okay, so that's some of the year's digits. For my double declining balance method, this is double declining, so my depreciation rate will be twice my straight line rate. I could use 1.5 times declining. I could do 3 times declining. It doesn't really matter, but in this case, I'm doing a double declining, so I'm going to decline it double the rate of the straight line. Now, that doesn't just work out because obviously straight line works out because we straight lined it. Double declining to compensate for basically that you can't take out, say in this case, 2/7 7 times and still get a positive number. What it does is we do not start with our depreciable base, we start with the full purchase price or the full purchase price of the asset. So we're going to take our full purchase price of the asset and we're going to multiply that times 2/7 and which would give us $50,000 in the first year. However, it was not a full year, so we do need to multiply that times just the portion of the year we've got. So that brings us down to $29,167 is our depreciation for the first year. Now, in our second year, we are taking our net book value, which is the purchase price minus the accumulated depreciation, which in this case is $29,000. So we are going to take 175 minus, and I'm just going to, so I can drag it, do the sum of G13 to G13, but I want the top one to stay there when I move. Okay, so that sums up. So that gives me my net book value, is all that formula does. It takes my purchase price minus all my accumulated depreciation. Gives me my net book value. My net book value I then multiply times, times 2/7, which is the double my 1/7 straight line rate. So 2/7 is double declining, which means in the second year I will have $41,667 of depreciation. That is the book value times 2/7. Now, if I continue this the whole way down, I'll just drag my formula down, and it doesn't work because I messed something up. Yep, there we go. I forgot to fix the D6. It needs to not move. Okay, now I'll drag my formula down. There we go. That looks better. Okay, so I drag my formula down, taking 2/7 of the net book value of the asset. I get 41,000, 29,000, 21,000, 15,000, 10,000, 7,000, 5,000. However, I am ending up with $161,000 of depreciation when I only should have 155. So I need to stop depreciating once I hit its depreciable base, which is 155. So I need to stop depreciating sometime back up here. So if I delete that, I still end up with 155,632. So this needs to be reduced by $632, which gives me 7,115 is that. And that is a plug to give me $155,000 of total depreciation. So all these equal $155,000 of depreciation, which brings me to $20,000 of salvage value is remaining, just like it is for all the others. That is double declining balance. Okay, those are all the calculations. Now, once we've done these calculations, every period, we're going to need to record our depreciation expense. That should be pretty straightforward. We're going to debit depreciation expense. Let's assume the straight line. So our straight line in 2020 is $12,917. We are going to debit depreciation expense, and we are going to credit accumulated depreciation. So accumulated depreciation is a contra asset account. It reduces the carrying amount of the asset. So it reduces the book value of the tangible asset on the balance sheet. So this is a balance sheet account, a contra asset account actually, and this is an expense account which will hit our income statement in this period. So that is the journal entry for basically recording that amount. Now every other period, or depending on your depreciation method, you're going to use one of these other numbers as your depreciation expense. Okay, so that is our basic calculation of depreciation expense and the journal entry. Moving on, now we're going to have a change in our estimate. We're going to change the useful life of this asset. So let's say in 2025, the company reevaluated the useful life of the machine and estimated that it had 5 more years and 20,000 more hours of life. Okay, so during this year right here, 2025, we're changing our estimate and saying it had 5 more years. It was only going to have 3 more years, 5, 6, and 7. We now think it'll have 5, which would be 25, 26, 27, 28, and 29. So we'll have 5 more years of depreciation. What do we do? First of all, there is no journal entry to the prior period. So we do not change the amount of depreciation expense we recognized in any of these prior periods, 2020 through 2024. We do not change the accumulated depreciation amount for any of those, or opening accumulated depreciation amount for that. So there is no journal entry when we make the change. However, going forward, we do need to change the amount of our depreciation because we now think the asset is going to be able to generate revenues longer than what we initially thought. So we will extend the useful life of this asset. To do that, we have to first start by figuring out what is our net book value and what is our new depreciable base at the time of this change. So we are making this change for the year 2025. So we need to figure out, well, what is our net book value at the beginning of 2025? Well, our net book value is going to be our purchase price minus the sum of depreciation to date. So for straight line, it's going to be 2020, 21, 22, 23, and 24. So that is going to be our net book value. So for straight line, we have a net book value of $73,512. If I want to do this for all the rest, I'm just drag it over. So this tells me the purchase price minus accumulated depreciation for the activity method. If I do straight line, sum of the year's digits, it's the same thing. Purchase price minus the sum of the year's digits, depreciation amounts, et cetera, et cetera. So there is my net book value. As you will see, because we have declining depreciation methods for sum of year's digits, double declining balance, the net book value at the end of those, what would be 4 years, is much lower than it is under the straight line and the activity method. So because of and we see that right here, because so much of the depreciation expense is essentially front loaded when we do those declining balance methods. Okay, now our salvage value. Our salvage value has not changed, so it's still going to be $20,000. So our salvage value is $20,000, which gives us this gives us our depreciable base that would be calculated under each one of these methods. Now, this should not need to be said. For a company, you're only going to need to calculate the one you're using. You don't need to calculate all of these. I'm just showing it regardless of which one you choose, I'm giving you how to calculate it for all of them. So if you were using straight line, our depreciable base is now $53,512. That is our new depreciable base. Because we are changing our estimate, that is what we are now going to depreciate out over the remaining useful life, which will be 5 years. So we calculate our depreciation the exact same way we calculated it above. So we take our $53,000 divided by 5 years remaining. All of these are full periods now. We're not doing there's no partial periods left. So that is how much we're depreciating. So that will not change for our 5 years. We'll depreciate $10,702 every year, which at the end will give us a total depreciation of $53,512 under the straight line method. Now, under the activity method, we have $54,000 of depreciable base remaining, and now we're just going to, again, figure out what is our cost per unit. So we're going to take our $54,000 divided by a total remaining production ability. Gives us, let's extend this out, $2.74 per hour of use is what our depreciation expense is going to end up being. So we will take that amount and we will multiply it. We'll multiply that amount times the amount hours we're using at this period, which gives us, for 2025, gives us $13,144. If we just extend that down, that gives us it for every period. And at the end, we have depreciated the full depreciable base under the activity method. Sum of the year's digits, we have 5 years remaining. So 5 years is 15. If we sum up 1 plus 2 plus 3 plus 4 plus 5 is 15. In the beginning of this, we have 5/15ths remaining. times, that's our depreciable base. So I'm just going to do this by hand. So 5, 4, 3 years remaining, 2 years remaining, and last year we have 1 year remaining. So there is our sum of the year's digits, which is just the number of years remaining divided by the sum of the year's digits, which is 15 in this case because it's 5. So we have in the first year we have 5 divided by 15 multiplied times the depreciable base of $23,527, and that gives us in the first year $7,842 of depreciation expense under the sum of the year's digits method. So there's our sum of the year's digits method. Moving on to our double declining balance method. Now, our double declining balance method, we have 5 years, so it's 1/5. If we double that, we now have 2/5. 2/5, and then that is going to be multiplied times whatever our carrying value is of the asset. So the carrying value of the asset is $37,962 now. So in our first year, it's going to just be 2/5 times that carrying amount. In our second year, it is going to be 2/5 times the carrying amount minus the accumulated depreciation. 2/5 is the amount of the double declining balance, double 2. Instead of 1/5, it's 2/5 times whatever the net book value is, which is going to be, in this case, our beginning net book value minus our accumulated depreciation under this method. So even after just two periods, we have overshot. We only need $17,000 of depreciation. Even after 2 periods, we have $24,000. So in period 2, actually all we're going to be doing is taking $2,777 of depreciation expense in year 2. That gets us our full depreciation base out. So there's actually no depreciation under the double declining balance method for the final 3 years. And that's because we'd already depreciated so much, and the salvage value is actually pretty high for this asset. So that's what leads to so many years with no depreciation expense, because essentially the salvage value is what would have been depreciated at that point. Okay, so that's how we would change our useful life. Our entry every period going forward is just going to be our debit depreciation expense, credit accumulated depreciation, like what we saw up here. But the amounts are now going to be reflective of whichever method we choose in the period that we are in. Moving on to the asset impairments. So let's say in 2028, the company realized that the machine was likely obsolete. So there's something that triggered them to assess and realize there's a chance it might be obsolete. Now they have to do their impairment assessment. So as part of this, they estimate the expected future net cash flows at $15,000, and the fair value of the asset is $12,000. The company will continue to use the asset through its remaining useful life, but it will have no salvage value. So they are going to continue to use the asset. They're not going to hold it for disposal. So we need to calculate the impairment, and then we need to calculate what their depreciation is going to be going forward on the new impaired asset. Now, if they were holding it for disposal, there'd be no need to calculate future depreciation or to calculate a depreciation schedule, because the asset is just going to be held at its fair value until the time it is sold. There's no depreciating assets held for sale. So regardless, step 1 is figuring out, well, what is our net book value in 2028? So our net book value is, we'll just calculate this for each one, is going to be our book value minus the sum of, let's see, those 3 years of depreciation. So our net book value under the straight line would be 41,405, and then I'll just drag that over and it'll give it to me for all the rest. So there's our net book value. Now the fair value of this asset, it says the fair value asset is is $12,000. So if you'll note, as we talked about earlier for impairment, the expected future cash flows of $15,000. Well, that is far lower than the net book value of under any of these depreciation methods. So, and that is why we need to so we have impairment. We now need to figure out how much is the impairment. The impairment is the difference between the net book value and the fair value. But we know we have to have impairment because we know there is impairment because the expected future cash flows is lower than the net book value under all of our, regardless of how we were going to depreciate it. So our fair value is going to be $12,000 for, that doesn't change based on the depreciation method. It's always $12,000 is the fair value. We get that out of the problem, which means we have impairment is the difference between the net book value and the fair value. So impairment under this, if we were doing straight line, the impairment would have to be $29,405, 26, 12, 8, depending on which method of depreciation was being utilized. So then we need to record our journal entry. Our journal entry is to record a loss. That loss will hit the income statement as a loss on impairment. And we need to basically ramp up our accumulated depreciation, which are a contra asset, as we reduce the carrying value of this asset. So if we were to do a straight line, our impairment would be 29,405, 29,405. So we're going to debit loss on impairment for $29,405, and we are going to credit accumulated depreciation for $29,405. That's if we were doing had been doing straight line depreciation up to this point. Okay, now, because we're going to continue to use this asset, we need to have a new depreciation schedule, and we only have 2 more years of life left in it, so it's going to basically be 2008 and 2009. So we have these 2 years of life left in the asset. So under that method, our new carrying value of the asset is $12,000 for all these assets. So we have $12,000. Under straight line, we want to do, well, 1/2, 1/2, and that is $6,000 every year. That is the amount of depreciation we will recognize over the next 2 years. If we're doing activity method, here's our continued activity. So now we just want to do equals $12,000 divided by our total amount of activity, which is that amount right there. So it's going to end up being $1.76 per hour of usage. So we'll take that, we'll just multiply that times the number of hours we're using to give us the amount of depreciation each period. So there's the amounts we're using. We end up with $12,000 depreciated out, which is what we should do because that is the amount we have to depreciate. So that's our activity method. Under the sum of the year's digits method, we have a total of 2 plus 1 is 3. So in the first year, we need to have 2/3 times $12,000. And in the second year, we are going to have 1/3 times $12,000. So there's our sum of the year's digits. And for our double declining balance method, well, this gets really weird because our single declining balance method was 1/2. So if we doubled that, it'd be 2/2. So 2/2, which is 1, times 12 means the whole amount will be depreciated in the first year. So here's our new depreciation schedule after the impairment. So we just continued moving on with our depreciation under the new adjusted basis after the impairment. So that wraps up impairment. It also wraps up the problem I wanted to cover in this section. So have a great week, everybody, and I will see and talk to you later.